Your inflation, your petrol price, and even your stock market can sometimes be affected by a war happening thousands of kilometers away. And when conflict appears in regions that control the global energy supply, markets start paying the attention very quickly. But why? Because wars are not only military conflicts, they are also economic events. Energy markets react, investors move money, and financial markets adjust the expectations. In this video, we will be breaking down the entire situation step by step. Why this conflict started, what is happening in the region, which global markets are affected, and most importantly, how this conflict can influence global markets and Indian investors. Geopolitical tensions in the Middle East have been building for many years. Several issues have contributed to the rising tensions in this region. Regional power competition, security concerns between multiple countries, strategic alliances involving major global powers, and disputes over nuclear development and military influence. These tensions gradually escalated into direct confrontation. When geopolitical tensions rise in regions that influence the global energy supply, financial markets begin reacting quite quickly. Because the Middle East is not only a geopolitical region, it is also the center of global energy supply. A large portion of world's oil supply comes from the Middle East. Oil from this region travels through narrow shipping routes before reaching the global markets. Whenever tensions rise in these regions, energy markets immediately start pricing in the risk. Even the possibility of supply disruption can cause the oil prices to rise. And when oil prices rise, the effect spreads across the global economy. Transportation cost increases, manufacturing cost increases, energy bills become more expensive, which means inflation pressure can appear in many countries. But oil is only the first market that reacts. When geopolitical risk increases, investors reassess the risk in global markets. Some investors reduce the exposure to risky assets on a temporary basis. Others move money towards assets that are considered safer. For example, government bonds, gold, certain currencies. These capital movements can create volatility in financial markets. But these reactions are often driven as much by psychology as by economic fundamentals. But not every industry reacts the same way. Some sectors may benefit during geopolitical conflicts. Energy companies sometimes gain if oil prices rise. Defense companies may see increased government spending. Commodity markets may experience strong price movements. But other industries can face the pressure. Airlines, transportation companies, industries dependent on stable global supply chain. These sectors can struggle when energy costs increase or shipping routes become uncertain. But the biggest question for many investors is this: what does it mean for India? Now, India imports a large portion of its energy needs, which means oil prices play an important role in the Indian economy. If the oil price rises significantly, several economic effects can appear. Inflation pressure can increase, the rupee may weaken because the import cost will rise, interest rate decisions may become more cautious, and markets may experience a volatility. However, the impact depends heavily on how long the conflict lasts. Because markets always try to answer one key question: is it a temporary shock or a long term crisis? Financial markets react very quickly to the uncertainty, but they also adjust quickly when the risk decline. Many geopolitical conflicts create short term volatility rather than long term economic damage. Investors usually watch three signals very closely: energy prices, supply chain disruption, and global capital flows. These indicators help determine whether the conflict becomes a temporary shock or a structural economic problem. Financial markets are deeply connected to the global events: energy supply route, commodity market, investor sentiment, capital flows across countries. Understanding these connections will help the investors interpret the market movements more clearly. Because sometimes the biggest market movements begin far away from the stock exchange. So the next time geopolitical news appears in the headlines, remember that behind the conflict there is also a global financial story. And if you want to understand how global events influence the markets, subscribe to this channel, because here we decode how the world moves with the money.